Here is a summary of Alibaba's BBA Q3 Fiscal Year 2025 earnings call transcript, focusing on key financial metrics, management's outlook, risks, highlights, and lowlights, as well as important statements from the CEO and CFO. Alibaba Group Q3 FY 2025 earnings call summary. Good day, everyone. We've just concluded Alibaba Group's earnings conference call for the quarter ending December 2024. The company reported strong progress in its transformation, with core businesses showing accelerated growth and a continued focus on AI and cloud computing. Key financial metrics. Overall revenue, excluding consolidated subsidiaries, grew 11% year-over-year. Consolidated revenue, 280.2 billion renminbi, an increase of 8% year-over-year. Consolidated adjusted EBITDA increased 4% to 54.9 billion renminbi. Adjusted EBITDA growth would have been 5% on a like-for-like basis excluding long-term cash incentives. Non-GAAP net income, 51.1 billion renminbi, up 6% year-over-year. GAAP net income, 46.4 billion renminbi, a significant increase of 333%. Operating cash flow, 70.9 billion renminbi, up 10% year-over-year. Free cash flow decreased 31% to 39 billion renminbi, mainly due to increased cloud infrastructure investments. Net cash position maintained a strong 378.5 billion renminbi, approximately $51.9 billion, as of December 31, 2024. Segment performance. Taobao and Tmall Group, TEG revenue increased 5% to 136.1 billion renminbi. Customer management revenue, CMR, grew 9% year-over-year, driven by online GMV growth and improved monetization. 88 VIP members reached 49 million, maintaining double-digit growth. Adjusted EBITDA increased 2% to 61.1 billion renminbi. International Commerce Group, AIDC revenue grew 32% to 37.8 billion renminbi, primarily driven by strong cross-border business performance. International Commerce Retail business revenue increased 36% to 31.6 billion renminbi. Adjusted EBITDA loss widened to 5 billion renminbi from 3.1 billion renminbi in the prior year, due to increased investment in user acquisition in key overseas markets. Forecast, expected to achieve its first quarter of profitability in the next fiscal year. Cloud Intelligence Group, revenue grew 13% year-over-year. AI-related product revenue continued its triple-digit year-over-year growth for the sixth consecutive quarter. Adjusted EBITDA increased 33%, driven by a shift to higher-margin public cloud products and improved operating efficiency, offset by investments in customer growth and technology. Local Services Group, revenue grew 12% to 17 billion renminbi. Adjusted EBITDA loss narrowed significantly due to improved unit economics and increased scale. Cainiao, revenue decreased 1% year-over-year. Adjusted EBITDA decreased 76% due to ongoing restructuring. Digital Media and Entertainment Group, revenue grew 8% year-over-year. Adjusted EBITDA loss continued to narrow. Management's forecasts and future outlook. Cloud Intelligence Group, revenue growth is expected to continue accelerating. AIDC, targeted for profitability in the next fiscal year. Other internet platform businesses, continued improvement in operating efficiency, with AMAP achieving profitability this quarter. The majority of loss-making businesses are expected to reach break-even and gradually contribute profitability within the next 1 to 2 years. Strategic focus. Alibaba will continue to concentrate on 3 core business categories. 1. Domestic and international e-commerce. 2. AI plus cloud computing. 3. Internet platform businesses. AI investment. Over the next 3 years, Alibaba plans to scale up investments significantly in three areas as part of its broader AI strategy. 1. Infrastructure for AI and cloud computing. Planned investment in cloud and AI infrastructure over the next 3 years will exceed the past decade's spending. 2. AI foundation models and AI-native applications. Substantially increase R&D investment in AI foundation models to maintain technological leadership and drive AI-native application development. 3. Transforming existing businesses with AI. Increase investment in AI application R&D and computing power to deeply integrate AI across all businesses. Shareholder returns. The company continues to optimize its balance sheet through strategic divestments, share buybacks, and debt maturity extensions. They repurchased $1.3 billion in the December quarter and have a substantial amount of dry powder for future buybacks. Significant risk factors: intensifying competition, particularly in the cloud and AI space within China and globally. Regulatory environment: ongoing regulatory scrutiny, and potential for new regulations impacting operations. Macroeconomic conditions: global and China-specific economic slowdowns could impact consumer spending and enterprise investment. Execution of AI strategy: the success of massive investments in AI infrastructure and R&D hinges on effective execution and market adoption. Geopolitical risks: potential for further export restrictions on key technologies, particularly semiconductors, which could impact hardware procurement for AI infrastructure. Highlights: accelerating core business growth, demonstrating a positive trajectory after a year of transformation. Robust AI momentum: AI-related product revenue continues to grow at triple-digit rates for the 6th consecutive quarter. Cloud intelligence growth: accelerated revenue growth, driven by strong demand for public cloud and AI products. Improved operating efficiency: multiple businesses are showing improved profitability or narrowing losses. Strategic divestments: completing the disposal of non-core assets like Sun Art, streamlining operations. Strong shareholder returns: significant share repurchases demonstrating commitment to shareholder value. Leading AI foundation model: Qwen 2.5 Max achieving industry-leading performance and strong developer adoption. Lowlights: decreased free cash flow, a significant drop attributed to increased investments in cloud infrastructure. Widening AIDC loss: increased investment in user acquisition in overseas markets led to a larger EBITDA loss in the international segment. Sanya revenue decline: faced a slight revenue decrease amidst ongoing restructuring. Most important statements from management. Andy Wu, CEO. Over the past year, we have pursued our user-first AI-driven strategy and focused on our two core businesses of e-commerce and AI plus cloud. After a year of transformation, our core businesses have demonstrated accelerating growth momentum. Our strategic direction and roadmap are clearer than ever. We'll continue to focus on 3 business categories. First, domestic and international e-commerce. Second, AI plus cloud computing. And third, internet platform businesses. Over the next 3 years, we will scale up investments in AI infrastructure, AI foundation models, and AI-native applications, and transforming our existing businesses with AI. Our planned investment in cloud and AI infrastructure over the next 3 years is set to exceed what we have spent over the past decade. On AI applications, the models are becoming increasingly powerful and evolving rapidly, making it challenging for me to specify which areas hold the highest potential. I believe all applications could have significant potential, and we are exploring some exciting opportunities internally. AI technology presents powerful opportunities to enhance user value across our e-commerce and other internet platform businesses. Tomi Su, CFO. The strong financial results of the past quarter show that we are making very good progress to ignite growth in our core businesses. We have been actively managing our balance sheet through strategic divestment of non-core assets, share buybacks, and effectively extending our debt maturities at attractive rates. On a consolidated basis, total consolidation revenue was 280.2 billion renminbi, an increase of 8%. Consolidated adjusted EBITDA increased 4%. Our non-GAAP net income was 51.1 billion renminbi, an increase of 6%. We will continue to execute our strategy and make significant investments to seize opportunities presented by the AI era. On shareholder returns, we will continue to deploy our cash effectively and optimally to enhance shareholder return, and will continue to execute share repurchases in accordance with the allocation and guidance given to us by the board of directors, and with an eye on the share price. On future divestments, we will keep seeking opportunities to divest from non-strategic minority-owned assets, and you can expect more announcements as we progress. In conclusion, Alibaba is demonstrating a clear strategy focused on core businesses, particularly AI and cloud. While significant investments are being made in these growth areas, leading to some short-term impacts on free cash flow, the company maintains a strong financial position and commitment to shareholder returns, with a positive outlook for future profitability and growth.